massive scale, intense price pressure. That's surprising, but it does reflect the reality of today's EV market in China. This is a tightrope walk that has to be traversed. Only the strong will survive. It's a race to the dominance of the 21st century product configuration. And right now, China has the inside track.
Chinese carmaker BYD is one of the world's hottest brands. So why is it struggling to make money? Bill Russo is a former auto executive and head of consulting firm Automobility in Shanghai. Bill, thanks for joining us. Bill, if we just look at BYD, we know that it's cranked up exports in recent years, including to Europe, where I am. But why is this company, and perhaps the Chinese electric car industry as a whole, why do they seem suddenly more fragile?
Well, yeah, they reported a 30% drop in profit in the second quarter and record deliveries. So these seemingly opposite facts are what we've heard from their quarterly earnings announcement. That's surprising, but it does reflect the reality of today's EV market in China. Massive scale, intense price pressure. It's not about weakness, though. I think it's about industry dynamics. And you've got the fact that there's just too much capacity in China that's chasing a finite pool of buyers. And companies are using price as a weapon. We have to think about this as this is a race to dominance of the next generation of product configuration of electric vehicles. And BYD is using the weapons at its disposal, which is their ability to scale in high volume the component technologies and trying to eliminate competition in the process.
I want to talk more about BYD in just a moment, but if we look at the entire Chinese electric car industry, we know that analysts have been warning about this for some time, and yet production continues to increase at a torrid pace. We saw just in the first half of this year, production and sales both up by more than 40% from last year. Can you help us understand what's behind this frenzy of production?
Well, the numbers tell the story. China's NEV penetration is already above 40% of new car sales. If you just look at passenger vehicles, it's more than 50%. So if you're chasing after opportunities to grow, that growth is mainly coming at the expense of combustion engine powered vehicles. And the reason why that growth has happened is because the NEVs in China, new energy vehicles, compete very well on price. They're very affordable. So the price war is to eliminate the combustion engine, and that's had a net negative impact, significant negative impact on the legacy auto players who have historically done quite well in China. The overcapacity is because the companies are attracted to where the growth opportunity is. And if combustion engine is being eliminated, then you want to make sure that you have a seat at the new energy vehicle table. And to be aggressive on price is the tool that these companies are using to make sure that they survive in an era of consolidation that is yet to happen, but will eventually come. Because at the end of the day, economics are going to trump the chase for volume, and only the strong will survive. And the ones who can survive in the era of the electric vehicle are going to be the ones who can scale the key technologies around the electric vehicle.
Where is this leading when we talk about this era of consolidation coming up? Could we see companies being bailed out, for example, from the States, or will they be forced to slow down, or will this all just have to shake out in some sort of more chaotic way?
Well, the ability to scale is going to be the determining factor, right? And what are the core technologies in the future product configuration? Obviously, batteries, BYD being the second largest battery company in the world, China making 70% of the world's EV batteries and controlling, the supply chain. I think survival will be based on who can create the most favorable economics in economies of scale for a different type of a product configuration, an electronic device, a smartphone on wheels, which is what the car is evolving into. And that, I think, is going to require companies that have the ability to scale not just the batteries, but the core electronics and those that can deliver a more intelligent, connected in-vehicle, in-cabin experience. Companies like Xiaomi, who have entered the space, Huawei, which is a large integrator of intelligent connected vehicle technology, Companies obviously like BYD and Geely having the ability to scale the hardware part of the business. So I think those would be the vectors that I would be looking at.
Just to go one step further into the kind of political dimension of this, we know that the auto industry has become very important for China in recent years, especially with the collapse of the property industry. How much pain can Beijing tolerate if some of these companies begin to fail? This is a big job bringer, for example. What kind of factor does that play when we look at the economics of what companies survive and what companies don't? Isn't it more than just those who can afford to scale up and really succeed on the markets?
Well, I think this is a tightrope walk that has to be traversed. 7 years ago, 8 years ago, 2017, China made 28.9 million vehicles that year, and more than 95% of them were combustion engine vehicles. Foreign brands at that time had about 2/3 of the market share of the domestic market. Fast forward to last year, just 7 years, the automobile production in China went to 31.4 million units, so an incremental increase. But what was far different about the market last year? Chinese companies had 68%, more than 2/3 of the domestic passenger vehicle volume. So they completely flipped the advantage to China. They have more than 80%. All the growth in that 7-year period was in the new energy vehicle category, which represented about 43% of all the automobiles produced. China produces 31.4 million units. 43% of those were new energy vehicles. It has 4 of every 5 of the new energy vehicles sold. So yes, there are structural capacity issues in China, but China's winning the race to the electric vehicle, and China's not going to damage its advantage when it comes to the next generation of technology. So again, it's a race to the dominance of the 21st century product configuration. And right now, China has the inside track. It's a market that has to push now, because of overcapacity, to look for markets outside of China that are less densely populated with EV competition, so they can get some of that average selling price up higher so they can earn more money on the units that they're selling.
Talking about exports, as you mentioned, Chinese companies have dramatically increased exports in recent years. At the same time, we see that production has continued to outpace the rate of exports. What will it take for exports to soak up more of that production? Is it just finding more of those markets? Is it being more successful? Is it just a matter of time?
China's goal is not to be the export nation for the automotive industry. The goal is to dominate the ability to produce transportation equipment, automobiles, and other at scale. And that involves supply chain. That involves some manufacturing domestically. But if I look back on history, Germany, Japan, Korea became automotive powerhouses, not because they made everything at home, because they were able to get their brands to be relevant all over the world, and they built those factories close to where the demand was. That's where China is going with this. Export's not the end game. Of course, you want to employ a large number of people at home. As I said, 31.4 million units. That's 34% of all the cars made in the world. It actually produces about 2/3 of all the EVs made in the world, and about 70+% of all the EV batteries. So on the race to the future of electric powered mobility, China has a decided advantage, but its goal is not to be the export nation. Right now, if I look at the numbers, in 2017, let's go back to that 28.9 million year, less than 1 million of those were exported. Last year, 31.4 million, 5.9 million were exported, and this year we're going to see 6.5 million exports. I think we're going to eventually settle that China's going to probably hit a peak on exports. It's somewhere in the 6 to 7 million unit range. And then eventually that capacity will be distributed to other markets where Chinese companies like BYD, Geely, Chery, and others start to establish their overseas footprint in the manner that we saw Japan, Korea, Germany, and all the other countries that have preceded it doing as their demand grew in overseas markets.
I would imagine then that export markets would be key for particular companies within the Chinese car field, the Chinese electric car field, such as BYD, for example. We often talk about the turbulent situation with different markets right now and the fact that the U.S. market has pretty much closed itself off. Is that a major problem if you're a BYD and you're trying to establish those export markets for your own firm, for your own ability to scale up? Or can that be found elsewhere in other markets?
The U.S. has put the Great Wall of tariffs around it, and China knows that game and will avoid it. So if I look at the countries that China is selling to, number 2 on the list of made in China export destinations is Mexico, a country that borders the United States. There's a significant presence in markets all over the world, Middle East, Southeast Asia, the global South, which China has prioritized, and Europe. Europe is still, even though there are some resistance in the form of tariff walls, they're not completely impermeable. And China has what the world needs right now, which is a supply chain. It's still a big market. It's still a market that offers opportunities for companies that are willing to partner with China. But it's also a place that if you don't have access to the highly scaled supply chain for these new technology domains, then you're probably going to be at a competitive disadvantage. So I think the advantage that China has is it has other places to go. U.S. is not the only game in town. It's a big market, but I think they can afford to pause on the U.S., put the focus on the other markets. And one thing that I think China's trading on is the universal value proposition of affordability. If you can make products that today are gentrified, democratize those by making them affordable, then your market opportunities exist in the emerging world as well as in the mature markets around the world.
We see that some of the biggest Chinese car makers are publicly listed, and it seems that while investors weren't happy with those second quarter figures that you mentioned from BYD, for example, they're still incredibly bullish on this industry. What do you think it'll take to spook them, if anything at all?
Well, I think consolidation is what they're all looking for, and I think that's going to, I think for the reasons you described earlier, there's a lot of fragmentation in China and a lot of regional money in different cities around China to prop up companies that have not been able to earn the right to survive. I think consolidation is what's going to ultimately rationalize the oversupply condition and begin to make it more of a normal market. I think that's what the investors would like to see is a more supply and demand balanced world. But I think right now what we're living through is the transition period, and what you're witnessing are companies that are on a race to dominate the market in the aftermath of that transition. And that race to dominance comes at the expense of short-term profitability. I think it's a speed bump. I don't think this compromises in any way the strength that companies like BYD and other disruptors like Xiaomi, like Huawei, like Chery and Geely, these companies are going to survive any form of consolidation, and they're going to find a way to become global companies.
Bill, I want to wrap up by asking about legacy car makers. You've touched on this already, but you talk a lot about the need for these bigger mainstream car makers that we know before Chinese electric car makers really sort of made headways, that they need to take the high road in their competition with Chinese car makers. They need to be bolder with innovation, to work with and learn from the Chinese. Do you see signs that they're doing this?
Some are attempting, but it's toe in the water, not full-fledged commitments. Stellantis has partnered with a company called Leap Motor, who I visited last week, a very impressive company in terms of its ability to scale electronics. I think that's a good move. They have 20% share in the company, and they're selling through their global distribution channels. Volkswagen is collaborating with XPeng, and it began with sharing some of their software-defined vehicle features and capabilities, I think what you're going to find is accessing the Chinese technology ability to scale some of the critical technologies is going to be key. And I think more of those types of partners, there just aren't very many examples right now, but there are some. Toyota's working with some of the AI companies, the autonomous driving companies. They're working, I think obvious choices. You've got to work with Chinese battery suppliers and find a way to get the investments to come the other way. Right now, up until recently, I should say, foreign companies came to China to build factories to sell foreign spec products to Chinese consumers. Now we need to come to China to work with Chinese technology companies to access the economies of scale of the next generation of automotive and mobility technology. And under the terms that we set for them, it shouldn't be a free ride. It shouldn't be come to the rest of the world and sell the Chinese product. Partner with us, collaborate with us, and form joint ventures with us. They did it to the Western world. We can flip the script and do it in reverse. But I think that takes courage and it takes government support. Policies in the overseas market shouldn't be about restricting Chinese entry. It should be about guiding Chinese entry in a way that's favorable to the domestic industries that we shouldn't be trying to protect, that we're trying to make more successful.
I asked you about consolidation within China. Do you think that maybe legacy automakers are in for a period of consolidation as well as they try and compete?
And if they don't pivot and if they don't find ways of collaborating, yes, they will become less competitive. There are very few foreign companies that have been able to establish themselves in the aftermath of this transition. So far, right now, only Tesla is a top 10 selling brand in the Chinese market in the EV lane. All of multinational companies that once dominated China are really not competitive in that lane. They're still trading on, milking the old cow. They haven't built the new cow yet.
All right, that's Bill Russo with Automobility. Bill, thank you so much.
My pleasure.